So in this one, we always like to kick off with the summary of what is happening with the product supplied. And remember, there's that timing delay of, product supplied is literally what's being supplied to the end user. So it's going from the last point in which the EIA calculates to either the into the rack, and then it goes from there, and then it gets filled into different tankers to go either on a barge or into a entity that then goes into, as you see it dropping, the hoses into the big gigantic hole in the ground for to replenish the gasoline front. So again, this is something where this is kind of the last piece, and that's why we talk about Gas Buddy and talk about some of those different pieces on the demand side. But it's always important to look at it in context in terms of where were we this time last year, and that's when we start looking at where things are. So last week, we had a decent pop in demand of 15.094 million barrels a day, with a lot of that being driven by diesel and or distillate. And now that has come off a bit as you kind of see things flatlining. And when you look at the current, right now, we had demand of 14.504 million. Again, that's just looking at gasoline, jet fuel, disti, and resid. Again, mobility products. So here, when we always look at that average, and one of the things that we've been saying is that you were just going to see kind of this flattening. And then the flattening is the response to inflation. It's the response to price, where people are like, look, I'm going to do what I need to do. I'm not going to do anything more because I can't afford it, or we're going to avoid it. And that's where you see that there's typically like that pivot higher, and we're just not getting the same type of pivot. Instead, we're just flatlining. Now, diesel and distillate will continue to be a bright spot due to trucking. But when you look at what is happening on the heating side, heating demand is falling off now because we are getting a bit warmer. We're coming into spring. So really that delta that's going to take us higher is that gasoline push. And when we talk about demand destruction, it's not that we're going to see what happened in 2020, that purple line, but rather you're just not going to get the same type of movement higher. It will go up. It will most likely be above 9 million, either this week or next as things get nicer. But because you did have some of that weather impact. But again, that's just going to be a matter of, where does that fully bake in? And we just think that that's where you're going to see some of those losses. Now, when you look at distillate, Disti had a stock build of 330,000 barrels. It's still 24.3 million below the 5-year average. And Pad 1 had a small build, but that's still 14.9 million below the 5-year average. And the reason why is, again, that's the distillate side in terms of the heating oil demand. As we get, as spring comes into New England, that'll drop some of the demand. So you should see Pad 1 starting to pick up a bit, which will help offset the loss of imports from Russia, because we've been importing Russian diesel, just as the UK has been in other parts of Europe. But again, it's important because it's coming at a quote unquote good time. I'm not saying that it's good and anything that's happening, but just on a seasonal basis, this is a good time for us to kind of cut ties, because we don't really need it to the same level we normally do. Yes, it'd be good to increase storage. That will happen using the Colonial Pipeline. Hopefully, people in the government wake up and waive the Jones Act to enable some of the movements from Pad 3 into Pad 1. But we can all hold our breaths, I guess, or not, because then we would then be passing out. So when you look at imports dropped 54,000 barrels a day. There was a drop across the board. We expect that to continue to come down as some of the last remaining Russian cargoes get offloaded. So far, realistically, well, if it was already purchased, the government is allowing you essentially a 30-day window to bring it on shore. So again, they're either going to try to speed it up, get it here as quickly as possible, or sell it off. So we could get maybe a quick pop just because there's that rush to offload, but then you'll see that flatten out. And then when you look at just where we are against the 29-year average, still in a bullish position, still below that 29-year average. But as we were saying, the rate of change was slowing. It had that big drop, and now we're starting to come back up. And we should start to approach the 29-year average as we get through the middle, really to the end, really the back end of April. So then when you look at supply, the demand side, you can see that it dropped down. We were expecting it to come to the 5-year average. Instead, it went right through. So we do expect this to bounce back up and go just above that 5-year average. So again, it'll recover. It'll recover to something closer to about 4.1, just between that 4 to 4.2 maybe on the upside, because it did have that extended drop. But we will see some of that coming through. When you look at trucking cooled off a touch, and it's not because there isn't demand. It's just when you look at the supply chain, and we'll talk about retail sales later today in the Econ show. But when you look at retail sales, they came in a bit below estimates. You're starting to see inventories pick back up. So even though there's still a lot of stuff coming on the coast, as the consumer starts to pull back a bit, and again, I'm not saying they're going to stop altogether, because in America, we'll borrow till our eyes bleed to in order to keep spending. It's just we'll spend a bit less. And that's why we will stay within this level, but it's come down a bit. We were thinking it was going to be between that 150, 170. Now it's just below 150. We will get a little bit of that bounce back, but it's probably going to be something closer to 140 to 155. And you're starting to see that kind of naturally move down as inventories pick back up and retail purchases kind of level off. And that's when you can see load availability again kind of going sideways. We've seen some of the rates come down, but it's also diesel. Diesel prices have gone through the roof, and some people just aren't willing to pay. They're looking to wait, or just cutting what they were expecting just in order to try to save some cash. And here, when we look at rail traffic was up versus last year by 0.9%. Coal is going to continue to be the bright spot. When you look at grains and forest products, again, a hard comp, but those are going to still stay strong. And then motor vehicle, hopefully for my sake, because I have to go out and buy a new car after having a great deal on the one that just got totaled, I am going to have to, hopefully that picks up, so there's more available. But then when you look at petroleum and petroleum products, that still remains weak, just given where we are in the cycle. Intermodal units continues to struggle. We're down about 9.1% versus 2021. And again, it's just going to be tough to catch that up, just given the inherent issues that remain from a labor standpoint, from a logistical standpoint. So again, this is something that would kind of help decongest a bit, because the more we have trucks on the road, again, the faster things get ripped up. Trucks are heavy. They use a lot of torque, especially when you're in stop and go traffic, which is what really helps destroy those roads, especially the ones that have been subject to the freezing and thawing process throughout the winter, creating those cracks and those bigger and bigger potholes. So the lull in shipping has ended. You're starting to see it come back up now. Again, there's that timing delay of what is happening in China, which we had those shortfalls from the Lunar New Year. Now it's coming back up, but now we're also getting new lockdowns. So that you're going to see this kind of ebb and flow. So here right now, we will continue to see this build through April. But then as we get out of April and further into May, you could see that come back down as some of those shipments are held up in China. But so far, again, still staying strong, still more to come on shore. This is looking at the temperature outlook. You can see how temps continue to move above normal in the Northeast, well above normal. So again, that's going to continue to be a big driver as we go forward for some of the different the distillate builds. You're going to have some of that slowing demand as heating oil demand diminishes a bit. Now going to gasoline. So we normally get draws this time of year. So that's why I think it's important to look at kind of where we are versus that normal dip. So even though we had a draw of 3.62 million, we're still only 2.2 million off the 5-year average. And it's because we're getting closer to that point. And we expect it to kind of stay within this level. And again, going a bit sideways, it'll still be a decline. It's just the rate of change won't be the same type as we've seen as things kind of flatten out. Imports slowed. Imports dropped 227,000 barrels a day, down 74,000 barrels. That is so. Pad 1 dropped 202,000. That's going to bounce back up a bit. It'll still stay depressed, versus the 5-year, but it will come back a tiny bit because we are seeing some of these movements. Europe is trying to balance their storage. So and this is when we can start talking, and I'm going to talk more about it in segment 3. But as the U.S. kind of doesn't see the same type of demand destruction, it's more along the lines of we don't see the same type of increase. We are seeing more demand destruction as we go into Europe and the emerging markets, and those are things that we're going to continue to talk about in segment 3. So this is a small sample set. So just to be clear, it's only 2,210 adults that took this survey. But I thought it was just interesting because nearly 1 in 3 adults drove less than usual, with majority citing high prices for the reason. So 53% said I drove my typical amount, 30% said I drove less. So again, you're starting to see some of those adjustments. It's still, as you can see, still people are driving as they normally do. And then the reason why they decided to drive a bit less was prices were higher. We're never going to get like 100% saying, nope, we're not driving less. There's always going to be, let's call it 40% that are just going to drive the same. It's that delta of, let's call it that 13% that is going to be how kind of flattish does that storage drawdown come? How does that demand look? And as we stay at these levels, you're going to see that get more impactful because the move up in gasoline prices was so parabolic, you didn't really have even a time to react. And there were some gas stations, depending on when they took deliveries, that you could get some decent prices. I know people were sending pictures, I think it was of Costco or Sam's Club, where the lines were like around the block because they were still cheap. And then as they get drawn down, then you start to see that get a mark to market. So those different shifts are happening. But again, you're starting to see it, and it never happens all at once. You never have kind of a snap of a finger and people don't drive. It's slow, and if you remember going through when all these different pieces that you continue to see, we will get some of that additional drop, especially as we stay elevated, and then the elevated side will remain problematic as we go from winter grade to summer grade. When we look at the congestion, so the congestion in China was before we had some of the steeper lockdowns, so we do expect that to come down a bit. Google mobility, as you've seen, it continues to grind up. It's going to continue to go up. It's against seasonal norms. We normally go up this time of year. It's just we think that it starts to flatten out, which I think you're starting to see in the Apple mobility data of kind of flattening and starting to come down. And that's searches. So that's why the searches are slowing. Apple's looking at how often you search, not how often you drive, because Google mobility data is saying, look, people are kind of doing the same thing. The pace is kind of slowing, but people actually searching is starting to roll, which is something that is just showing a bit of a flattening. When you look at gasoline demand, things are fairly flattish. According to the Gas Buddy data, U.S. gasoline demand rose 1.1% compared to the previous week, and the highest demand since the week of December 12th. Again, it's a matter of where are we versus historics. It's still a bit light, getting better, but as we've been saying, it's going to recover, but then kind of flatline, especially as we go through March into April. Gasoline prices are going to be a big driver of that. We were up 21.3 cents. We are now at $4.31 on our way to $4.32. The fact that crude prices have stopped going up and come down a bit, we should see a bit of a normalizing price level to the downside. The problem now, though, is the replacement factor when you're looking at winter grade into summer grade. So even though it should drop 30 cents, it's going to be difficult to see it drop the full 30 cents, knowing that you have because summer grade is more expensive to make. As you get that kind of pivot, it's going to be difficult to see some of those pricing adjustments. So it'll still be elevated. It'll come closer to $4 on the national side, but again, still be high. Now, the problem and the bigger problem remains diesel. So diesel was up 40 cents, came in at $5.25 even. Still, that's crushing. That hits every single piece of the supply chain. And that's why when we look at the inflation side, yes, gasoline is instant. You're paying that with your credit card, and that is, you know that, you see it, you feel that. But diesel is something that is spread across products. So, one can of Campbell's soup is going to go up by a smaller percent than when you go and obviously fill in, but diesel's a part of that cost. That has to get shipped, that has to get moved. And as the prices go up, it gets spread across all of the products that is on that truck. But again, it hits every single part, because when you're making the soup, you have to, bring in the ingredients, you have to bring in the aluminum, you have to bring in the paper for it, you have to run the machines, you have to, again, you're getting an idea, like every single piece of that requires diesel, which is why you see those prices continuing to go up. And diesel prices in the supply chain tend to be stickier, even though they go up and down. It doesn't have the same reaction as it does in gasoline, which is instant, because again, you're the point of purchase, where in diesel, you're really not that point of purchase. Or at least you're at the back end of it. So then when you look at blending components here out, you can see that on the blending component side, we had a draw of 1.68 million, which is 4.2 million above the 5-year average. So as we were saying, we kind of expected it to just go sideways a bit and then get more competitive. And we do expect this to break out and set those new, the new seasonally adjusted highs and still stay elevated in this period. Then when this is just looking at demand for gasoline, here you can see that demand has gone sideways. It didn't kind of get that normal uplift that we get. We will have a spike. It will go higher. It's going to disappoint versus the last several years, just because in comparison to that, that's where we get hit. It's again, not that huge drop off that we saw in 2020. And that was demand destruction. That was that demand destruction of that shock, the Uri dip. That was the demand destruction where people couldn't move. This is more of a pricing one, where some people won't care, some people will drive a bit more, but others will rationalize, and that will offset each other. So we just won't get the same type of bounce. When you look at what is happening in the U.S. here, you can see that things have kind of slowed down a bit. Again, it's just kind of seasonal. We will get picked back up as we head into April. The same thing with Apple trends, as we were saying. And then when we look at propane, propane had a draw of 2.22 million. That's 11.5 million below the 5-year average. You can see we're still setting seasonally adjusted all-time lows. And for 2022, all-time lows, but we should start to see that flatten out and even start to curl higher. As we are with the days of supply, we're still going to stay flattish. We're still going to be very much on the low end. But the hope is that you get a supply response and you start to get some of that slowdown on the chemical side, just from, again, some of the weakening demand that we've started to see leak into the system. Jet had a draw of 400,000 barrels, just 2.5 million below the 5-year average. And as we've been saying, we're just going to go sideways. We're going to be disappointing versus the normal, but we will get some normalcy just because, again, of the seasonality impact, but it's not going to be back to normal. And that's what we saw with that TSA in the airports. As we were saying, like we come into winter break, we have people traveling. For if you're in New England, it was 2 weeks ago. If you're in the South, it was either a week ago or this week. So again, those impacts are what took us up here. But you can see we're not getting back to normal. We're below normal, and we're just kind of bumping along where the highs are at the quote unquote normal of 2019. The highs of 2022 are at the lows of 2019, and then we're setting new lows, and we expect to just go sideways. And especially people don't like to do as much during a period of war or conflict. And are you going to look to travel abroad with so much uncertainty, or will you look to travel internally within the U.S.? So again, that's also going to impact some of those numbers. So the 12-week ahead passengers, they curved down a bit. It just fell by 0.9% week on week on the 12 weeks out. Not shocking. It's caused by Russia and China. That's more of the impact, where everything, as we've been saying, is increasing along seasonal norms, still below seasonal norms. It's moving up seasonally, but still below what would be normal. I think that's a better way to kind of clarify it. And then when we look at open table, things are getting mostly back to normal on getting out. So you're starting to see some of that baseline on the weekends, where we're still between that, up a little bit from 5 to 7%. But then during the week, we're about -5% to +5%. And we think that we're going to kind of hold that trend going forward. As prices continue to get filtered through to the end user, I mean, prices are already extreme when you look at restaurant prices, but they don't even capture the full amount of the impact. So as the full amount of the impact filters through, that will be a much bigger hit again. So now in the next segment, we're going to go a bit broader, look externally and globally to see what some of those shifts have been happening and how they've been adjusting around the world.